We'll be talking about cryptocurrencies here. And this week, we also continue to see cryptocurrencies pulling back. There has been that idea of a sell America trade. What we are seeing here is a developing trend in which investors worldwide are trying to de-risk, meaning to say that they are looking to not be involved in risky assets. We saw how equity market has pulled back. We saw how precious metal markets has rallied. And we also saw the yields in treasury bonds has been surging both in the States and in Japan. So there is that fear that this South America trade will actually result in a more severe trend. Okay. And the last shoe to drop, in my opinion, is cryptocurrency. It has not dropped the way I think it should, okay, after what happens this past week. If we see further sharp losses in cryptocurrencies, that will be the confirmation that I need that the whole world is de-risking. And that will be negative for all risky assets, whether it is stock market, whether it is cryptocurrency, which is again classified as a risky assets. Okay, so let's take a look at the three major coins which I normally follow. Here we have Bitcoin based on the daily time frame. We can see Bitcoin, ever since it traded to an all-time high of $126,230, has been basically been trading lower to a low of 80,600. We do see a bit of a rebound here that we ended at 97,800. Very, very close to my ideal target, which remember last week I was talking about the possibility of market testing this high at 98,500 to 101,800 levels. The market came very close, but not quite before it loses momentum to the downside. So if this momentum, this loss of momentum result in further losses, there's every possibility prices of Bitcoin may go under 80,600 and perhaps even lower than 74,500. And if that's the case, the immediate target will be somewhere near 58,400. It's a long way from where we are right now. And if that is actually what happens, this will be the confirmation that I know that I'm seeing in other asset class as far as the South America trade is concerned. Essentially, investors are trying to pull away from risky assets and go into the safety of hard assets such as gold and silver. Okay. Now here we have Ethereum, which is the second largest coin after Bitcoin. Okay, here we can see that the market here is generally bearish after hitting a high of just under $5,000. It went down to a low of 2006 and has been doing basically sideways with a top side about $3, $3,400. Prices has since comes back down, and if it breaks below 2,700, it will go all the way down to $2,000. So Ethereum is definitely in the cycle whereby it is already bearish, and if it breaks below the most recent $2,700, it will have more incentive to go down lower. So look out for $2,000 in Ethereum over the medium to long term. Okay, this is the 4 hours outlook. Okay, so internally, you can see 4 hours outlook top side. It looks like we have not been able to go up to this level at 3,006 to 3,008. Market is now trending lower. Now, immediately there is the possibility of prices hovering just under $2,870. If that's the case, it does present oddly a low risk, high reward payout trade setup. Now, if you believe that the rebound from 2006 is not over yet, and there's a possibility market going up to test the 3006, then of course, you want to be buying. And if you're buying anywhere between, let's say, 2007 to $2,870, it does present a very low risk proposition. Because if you are right, the payout will be at 3006, and if you're wrong, you cut loss at 2007. So on that basis, it does give rise to the possibility of a low risk trade result setup here. But considering the possibility of further losses in Bitcoin, maybe you should take another look before you attempt this so-called low risk, high reward trade setup. Market is generally soft. Okay, so that has been the case. So the last coin that we will be taking a look has been Ripple. Now, Ripple for quite some time has seen very strong support at $2. But we have seen the market going in and out of $2 many, many times. So as far as I'm concerned, it used to be relevant. Now it is not. Okay, previously at $2,000, I actually bought some. Market rallied all the way to $3.66. I didn't get up. As the market goes up and then bounce back, I actually got up somewhere around here. Okay, which was a good ride. Okay, but the market comes down and tests $1.58. That was totally unexpected. And this will be one level to defend. As the prices go down, you can see that the momentum is losing steam. We need to say that there is no sudden move to the downside. On the contrary, there may be market doing accumulation, okay? Because this is definitely an overshoot, $1.58. Okay. But if the market do go lower for whatever reason, and then it breaks, let's say the $1 barrier, it could go all the way to 46 cents. So until that happens, it is basically still very positive in my opinion, technically speaking. Anywhere between let's say $1 to $1.41, it is still good to buy. Okay. However, below $1, it can decay very fast to 46 cents. So if that's been the case, maybe there's nothing to look at as far as Ripple is concerned. Not the best trading opportunity that I can find in currencies, in crypto right now. So, okay, this will basically ends what I have been looking at in terms of the various asset classes. Now, the upcoming week, we have one major economic news. We have on Thursday, January 29, the first FOMC meeting, which is referring to the Federal Open Market Committee, deciding on interest rates. The market expectation is that there will be no change. The current interest rate is at 3.75. As far as the Fed fund rate is concerned, it's between 3.5 to 3.75. Now, there's a chart here provided, or rather, I got this chart from the Federal Reserve branch of the New York branch. Okay, in their website, they have this thing called the Fed Watch. Okay, which actually try to measure the likelihood of interest rates movements. Here, the odds of interest rate cuts come January 29 is actually 4.4%, which is not very, very high. It will never be zero, but it is on the low, very low end. On the other hand, the expectation of no rate cuts, or basically market holding at current rates of 3.75, is at 95%. So market expectation is that they are not looking at uh, any movements in the interest rate front as far as their meeting is concerned. And then on Friday, there is this piece of article coming out from Bloomberg in which analysts and economists do not expect a rate cut until June. Now, this is very different from what happened last month. As of last month, there were expectations that there will be the first rate cut that we see in March of this year. But now that is no longer in play. The first rate cut, economists think that may happen will be in June. That is 5 months from now. Okay, so in the interim, interest rate will not be a consideration. Okay, and then towards the end of this article here, it says that they are also expecting one more cut for 2026, and it could be the final cut. Meaning, as far as 2026 is concerned, there will be maximum 2 interest rate cut, and that will happen in September. Okay, so it's just not going to be like what we saw in 2025. We have 3 successive interest rate cuts. Okay, so maybe 2026 we don't see that. However, that is also dependent on who is the next Fed chairman. Now, the current chairman's terms end in May, and whoever comes in as the next Fed chairman is most likely going to be towing the White House narrative of lower interest rates. So I think the US government has already made up its mind between the fear of inflation running away and the need to stimulate the economy, or basically having lower interest rates. Now, as far as President Trump is concerned, he needs lower interest rates so that he can refinance the longer end of the yield curve at much affordable interest rates. Okay, during the COVID period, interest rate was near zero, and the US government borrowed a lot of money at near zero interest rate. Now, those bonds are up for renewal, and where the yield is for the long bonds in excess of 4%. So, can you imagine previously you borrowed those money at almost 0%? Now you have to refinance at 4%. That's a 4x increase in the cost of financing. So, obviously, President Trump is very interested to get interest rate down. Okay, not so much to stimulate the economy, but he needs to get interest rate down so that he can refinance the longer end of the yield curve at much more affordable interest rates. Definitely at 4%, it is not doable for him. Okay, so he needs to get interest rate down by to let's say 1%. And that can only happen if he get a very compliant Federal Reserve. So that we will have to see. Okay, this narrative may not hold water once the new Fed chairman is been announced. Okay, so this is something that you want to be aware of. So the South America trade, what exactly is this? This is a theme that has gained prominence again since last weekend when President Trump threatened to take Greenland by force. And at the same time, trying to punish the European nations that actually come up in support of Greenland by imposing a 10% tariff on those countries. So that has resulted in European countries reacting, okay, and say that they're going to rid themselves of US assets. And that actually happened because one of the news that hit the market was this Danish pension fund that actually say that they were going to unload the entire holding of $100 million in US Treasury in the coming days. So that is a sell America trade. So a sell America trade means there's a wholesale trend towards investor dumping anything to do with the US, including the dollar, including US equity markets, including US Treasury bonds. Also, if that happens, then we will see a phenomenon in which risky asset and risk-off asset move in the same direction. If we see US equity market goes down and the US Treasury bonds goes down, when they are not supposed to be going in the same direction, because one is risk off, one is risk on, right? So if that's the case, that is confirmation that there is an acceleration in the sell America trade. Okay, so this is exactly what happens. If there is going to be further sell America trade talks, it will be centered on these three major asset classes: the dollar, US equity markets, and US bonds. Okay, so what this is telling me is that the market can feel that there is something wrong. Okay, first we have the tension with its major allies in Europe over a piece of land in Greenland. So we are beginning to see the possible breakout of NATO. The biggest member of NATO is in the United States. Now, the United States is targeting its own allies over a piece of land. Okay, so we can see the Europeans are finally getting together and to come with a united front to oppose the United States. So that suggests a breakout of a major institutions that has been in place since World War II. Now, on the other hand, we also saw a surge in Japanese government bond yields. Now, this is tectonic. Okay, a lot of people don't know about this or doesn't know the implication. You know, money will go to where they get the best returns. For very long time, okay, Japanese interest rates at zero. It means the bonds yield in Japanese bonds is near zero. Hardly any incentive to be buying Japanese bonds. But that has changed, okay, over the last 2 years. We have seen yields on Japanese government bonds now is at record levels, at levels we have not seen since the 1990s. So from an investor point of view, it's beginning to make sense to take a look at investing in Japanese assets. If the yield is so good, and on top of that, we have a situation in which the Federal Reserve is cutting interest rates and the Japanese government is hiking interest rates. So there's basically a monetary divergence between the two central banks. So it pays to be investing in Japanese bonds because the yield is rising, whereas the bond, the interest rate in the States is coming down. Although it has not resulted in the yields in US bonds coming down just yet. Okay, but the window between the two is basically narrowing to the point whereby it now makes sense to take a look at Japanese assets. Okay. Now, on top of that, we have this stimulus package launched by the Takaichi government. They need money. And if the Bank of Japan is not buying, they have to raise the money by selling US Treasury bonds. So it's even more reason to look at Japanese bonds. Okay. And then don't forget, Japanese companies do not operate only within the boundaries of Japan. A lot of Japanese companies, okay, has been operating outside of Japan for decades, ever since the economy blew up. Okay, we have the likes of Toyota, Nikkei, and Nissan, all have factories in various parts of Southeast Asia and in Latin America. So these companies have not repatriated their earnings back to Japan because interest rate is near zero. There's no incentive to repatriate their earnings. But now, okay, with the yields rising in Japan, this company will have incentive to repatriate their overseas earnings back to Japan. That will cause further gains, okay, in Japanese assets. So this will have, conversely, a negative impact on US asset class, which also ties in with the sell America trade that we are seeing. So this is the fear that is gripping the market right now. Okay, I've been trading for so long, I can smell the fear. Okay, so the last asset that has yet to confirm what I think I'm seeing is the digital assets, meaning to say Bitcoin, Ethereum, and all the other digital assets. If we do see a sharp decline in, let's say, Bitcoin, Ethereum, or the other cryptocurrencies, that will be the last shoe to drop, in my opinion, because those are risky assets. So going forward, there is that risk that the market is in an inflection point right now. So just be aware that there's this possibility. Now, I want to bring your attention to this thing that has been bugging me for weeks now. Okay, there is someone by the name of Sui Bing that has posted on LinkedIn, alleging, accusing me of being a scammer. Apparently, he has been scammed $3,500 Sing in an investment scheme. They promised to pay him $16,000 in the name of Daniel Ang, and he came to LinkedIn and accused me of being the guy who scammed him. I wrote to him, that this is the letter that I wrote to him in response to the LinkedIn post. I tell him that I empathize with the fact that he fell for a scam, but the person doing the scamming is definitely not me. And I have made a police report, and I urge him to do the same, to lodge police report on his own. Okay, so this has been something that has been ongoing for some time. For too long, I have been led to notice that there have been people who hijack my Facebook page, sometimes hijack my images, even hijacking my post. I'm very active on Facebook, so those posts and my images has been used by some unscrupulous people going to Telegram to scam people with unrealistic returns. So don't be gullible. For those who are actually diligent enough, they will actually contact me to ask me if I'm the guy offering the investment. I tell him that's not me. Okay, so for those who actually take the initiative to reach out to me, they escape being scammed. But don't be gullible. Don't believe everything that you see and hear on the internet. Okay, if it's too good to be true, it usually is. So that maxim remains. Okay, just be aware that there are people impersonating me, going out there to solicit for funds. Okay, this thing just happened this week. SGX, which is the Singapore Exchange, the derivative side, actually reached out to me to be their external speaker. So the first event I would be doing for them will be next month on February the 12th. This will be for Phillip Capital in Malaysia, and they want me to talk about Chinese equity markets. So there will be something new. Okay. Essentially, I'll be talking about the A50 and the H50 index. So if you are anywhere remotely interested in knowing where I think the Chinese equity market is going, okay, then you are more than happy to register for this event. But you got to go to Phillip Capital website to register, because the event is for them, although it's sponsored by SGX. So that will happen on February the 12th, the week before the Chinese New Year, and I hope that will be a good tiding. Okay, so just be aware, and I will be putting updates. If I get the registration link, I will be posting it as well on my Facebook page. So watch out for that. Okay. So remember, on Monday, which is tomorrow, the Australian market will be closed for trading, as the Aussie will be celebrating their Aussie days. Okay. That is also something that we want to watch, because if the Australians are not in the market tomorrow, it will present a situation in which the Asian market will be so thinly traded. It will be very easy to move prices. If anybody want to manipulate prices or want to cause the market to go one way or the other, it will be a lot easier when one major player is missing in the Asian trading zone. So watch out for tomorrow morning if there's going to be some violent move, which is totally not unexpected. So this is all I have for you for this week. In the meantime, you take care, and I come back to you next Sunday. Bye bye.